Hello and welcome back to the USA Leaders. Can you imagine a number so large it's almost unfathomable? That's the current state of the US debt, towering at a staggering $34.59 trillion. To put that into perspective, it's more than 5 times higher than it was just 2 decades ago. Each second, the debt grows, and with it, the concern for future generations. It's not just a number, it's a looming crisis that could reshape the economic landscape as we know it. In March 2024 alone, the public debt of the United States was around $34.59 trillion, almost $2 trillion more than in July. The average American now shoulders over $104,000 in debt. This isn't just a national issue, it's a personal one, affecting every citizen's financial stability and the country's fiscal health. Welcome to The U.S. Debt, a sneak peek into the $34 trillion crisis, where we dive deep into the numbers that are shaping the nation's future. The U.S. debt, a term that sends shivers down the spine of economists and citizens alike, is the total amount of money that the federal government owes to its creditors. It's a combination of intragovernmental debt and debt held by the public. Intragovernmental debt includes money owed to various government trusts, like Social Security, while public debt consists of treasury bills, notes, and bonds held by investors and foreign governments. From the birth of the nation, debt has been a constant companion. The U.S. incurred over $75 million in debt during the Revolutionary War, which ballooned to more than $2 billion by the end of the Civil War. Fast forward to the 21st century, and we see numbers that dwarf those early figures. In the fiscal year 2024, the debt reached a jaw-dropping $34.4 trillion, growing by approximately $1 trillion in 2 separate 100-day periods since the previous June. This exponential growth is not just a result of recent events, it's the culmination of years of increased government spending without corresponding tax hikes. The annualized cost of servicing this debt was $726 billion in July 2023, accounting for 14% of the total federal spending. As the debt-to-GDP ratio tips over 102%, the question isn't just about how much we owe, but how we plan to manage this colossal sum without compromising the nation's economic future. Imagine a mountain of dollar bills so high that it reaches the stratosphere. That's the visual scale of the U.S. debt, which as of March 2024, stands at a colossal $34.59 trillion. It's a number so vast that it's hard to comprehend, but let's break it down to understand where this money is going. The debt-to-GDP ratio is a critical indicator of a country's financial health. For the U.S., this ratio is currently at 129%, meaning the debt is larger than the total value of all goods and services produced over a year. This ratio is significant because it gives us an idea of how likely a country is to pay back its debts without incurring further debt. So, where is all this money allocated? A significant portion goes to defense, with billions allocated to maintaining military operations. Healthcare, too, is a major expense, as the government strives to support public health, especially in the wake of recent global challenges. Education, infrastructure, and social security are other sectors where the debt money is channeled, investing in the nation's future but also adding to the debt pile. Each dollar of this debt tells a story of past decisions, current needs, and future obligations. It's a balancing act of epic proportions, with the scales tipping more each day. When we talk about the U.S. debt, it's not just an American affair. As of January 2024, foreign countries held a staggering $8 trillion in U.S. Treasury securities. Leading the pack is Japan, with holdings totaling about $1.15 trillion, followed closely by China, which holds around $797.7 billion. These numbers are not just digits on a balance sheet, they represent a complex web of international financial relationships. The implications of such significant foreign ownership are multifaceted. On one hand, it reflects global confidence in the U.S. economy. After all, investing in U.S. debt is seen as a safe bet. However, it also means that the U.S. is, to some extent, at the mercy of its creditors. A sudden sell-off by a major holder could disrupt the market, although history has shown that other investors are usually ready to step in. Moreover, this foreign stake in America's debt has more of a binding effect on international relations than a divisive one. It creates a mutual dependency. For instance, China's large holdings are intertwined with its strategy to manage the exchange rate of the renminbi. If China were to unload its US securities rapidly, it could backfire by causing its currency to appreciate, making Chinese exports less competitive. In essence, the foreign ownership of US debt is a delicate dance of economic diplomacy, with each step calculated to maintain a balance that benefits all parties involved. The US debt is not just a domestic concern, it's a global alarm bell. In 2024, the Congressional Budget Office projected a federal budget deficit of $1.6 trillion, with debt held by the public expected to rise to 116% of GDP by 2034. This level of indebtedness has a profound impact on the domestic economy, slowing economic growth to a mere 1.5%. It's a domino effect. As the government borrows more, it could crowd out private investment, leading to higher interest rates and stifling economic expansion. Globally, the ripple effects are equally concerning. The US dollar's status as the world's reserve currency means that any fluctuation in its value has worldwide implications. A default on the debt could severely weaken global trade and potentially tip the rest of the world into a deep recession. It could cause chaotic fluctuations in exchange rates and spike the prices of oil and other commodities. Moreover, rising US interest rates could shrink future incomes for the global majority by at least $360 billion, affecting nations already grappling with their own debt crises. In essence, the US debt crisis is a ticking time bomb with the power to disrupt not just American lives, but also the global economic order. It's a stark reminder that in our interconnected world, one nation's debt can be everyone's dilemma. In the face of a towering $34 trillion debt, the US government has rolled out a series of measures aimed at fiscal sustainability. The Penn-Wharton budget model outlines 3 policy bundles: raising taxes on corporations and high-income households, broad-based changes to Social Security, Medicare, and healthcare deductibility, and a mix of new tax revenues with spending cuts. These strategies are projected to reduce deficits by up to $6 trillion over a decade. However, the effectiveness of these measures is under scrutiny. While Bundle 2 promises a GDP growth of 9.8% by 2054, none fully stabilize the debt-to-GDP ratio, signaling the need for more comprehensive reforms. The Government Accountability Office echoes this, urging major changes to fiscal policies for long-term sustainability. With the debt ceiling suspended and continuing resolutions passed to avoid shutdowns, there's a bipartisan effort to address the crisis. Yet, the real test lies ahead. As the Treasury shifts from short-term bills to longer-term bonds, amidst quantitative tightening, the annual cost of servicing the debt is nearly $890 billion. It's a delicate balancing act, where the success of these measures will determine the nation's fiscal future. The stakes are high, and the world is watching. Peering into the future, the U.S. debt trajectory is set on an upward climb, with the Congressional Budget Office projecting that by 2054, debt held by the public could soar to 166% of GDP. This isn't just a number, it's a forecast of a potential crisis, where the weight of debt could slow economic growth and limit the U.S. government's ability to respond to future challenges. On the global stage, the U.S. debt saga plays a pivotal role in shaping international relations and trade. High U.S. debt levels can lead to increased interest rates worldwide, tightening financial conditions and affecting global borrowing costs. The International Monetary Fund, IMF, warns that such scenarios could pressure countries already facing high borrowing costs. The IMF's role is crucial as it monitors the situation, advising on policies to ensure stability and prevent a debt spiral that could destabilize the global economy. As the U.S. navigates this debt journey, the decisions made today will resonate across borders, underscoring the interconnectedness of our global financial system. In this deep dive into the U.S. debt crisis, we've uncovered the staggering $34 trillion burden, explored who holds the keys to this debt, and examined the government's strategies to manage it. We've also seen how this debt doesn't just affect the U.S. but has global implications, influencing everything from international relations to the world economy. Now, we turn to you, the audience. What do you think lies ahead for the US and the global economy? And what other topics are you curious about? Share your thoughts, and let's keep the conversation going. Together, we can unravel the complexities of our interconnected financial world. Thanks for watching.